All right. Hello, everyone, and thank you for being here today. I know you saw the title of this video, and I know that the phrase, you lose $4,000 and birthday in the same sentence can instantly cause a wave of worry. And let me assure you right from the start, we are going to clarify exactly what that headline refers to, why it's misleading, and what the actual financial mechanics are that are tied to your birth date. This is not about panic, it's about preparation. We're going to slow everything down and look at the actual changes that happen on January 1st and how a specific calendar date, the year you were born, not just the day, can fundamentally change the trajectory of your lifetime Social Security benefit. The loss isn't a surprise deduction. It's a permanent reduction in your monthly check if you claim incorrectly, and over a lifetime, that reduction totals far, far more than $4,000. So stick with me. We're going to simplify a complex but incredibly important topic. Let's start right where the worry begins, the link between your birthday and your Social Security check. The core of this issue comes down to two major concepts, your full retirement age, or FRA, and the delayed retirement credits. For most folks, the biggest single decision they ever make regarding Social Security is when they decide to start taking their benefit. And that decision is governed entirely by your date of birth. Now, I know the government and the SSA love to use acronyms, but FRA is one we must understand clearly. It is the age at which you are entitled to 100% of your primary insurance amount. That's the benefit you earned over your working life. If you take benefits before your FRA, your check is permanently reduced. If you wait until after your FRA, your check is permanently increased. The crucial part that links to this headline is that the full retirement age is not the same for every American. It shifts based on your birth year. For example, if you were born in 1954, your FRA is 66. If you were born in 1960 or later, your FRA is 67. But there are tiny, incremental shifts for the birth years in between. For those born between 1943 and 1954, it was fixed at 66. But for those born in 1955, the FRA jumped up to 66 and 2 months. For those born in 1956, it's 66 and 4 months. For 1957, it's 66 and 6 months. This is the calendar conundrum. If your birth date, that is, your birth year, falls on the cusp of one of these changes, the entire framework for your retirement changes. Let's talk about the difference between a birth year that grants you a full retirement age of 66 and 8 months versus one that grants you an FRA of 66 and 10 months. That 2-month difference might sound small, but here is where the loss comes into play. If you claim your benefit at age 62, the maximum age for early claiming, the calculation for your permanent reduction is based on the number of months you are away from your FRA. A person whose FRA is 66 and 8 months has a smaller permanent reduction than someone whose FRA is 66 and 10 months, if both claim at the exact same age. This is the hidden cost. By missing a slightly earlier FRA date, you might permanently lock in a smaller monthly check for the rest of your life. That small difference in the monthly payment, compounded over a 20 or 30-year retirement, is what the dramatic $4,000 headline is really trying to capture. That difference isn't a $4,000 one-time loss. It is a permanent monthly hit that adds up to tens of thousands of dollars. It's critical to know your specific FRA to avoid this unintentional reduction. If you're not absolutely certain of your full retirement age, please take the time today to look it up on the SSA website. It is the single most important number in your Social Security planning. And this concept goes in the other direction, too, the one that leads to the gain. Those delayed retirement credits, the DRCs, are the powerful incentives that Social Security offers to people who wait to claim after their FRA. Every month you wait, up until age 70, increases your monthly benefit. These credits accumulate at 2/3 of 1% per month, which works out to 8% per year. Again, if your FRA is later, you start earning these valuable credits later, which changes the total maximum benefit you can achieve at age 70. The takeaway here is not to panic, but to recognize that the government set up a sliding scale, and a specific year of birth is the only thing that decides where you fall on that scale. January 1st is simply the moment the calendar flips to acknowledge the next birth year cohort's rules, which is why that date is often cited in alarmist headlines. It's the annual moment of transition. Now, let's pivot to what actually happens every January 1st that impacts every Social Security beneficiary, regardless of their birth year. January is the moment the entire Social Security system adjusts for the year ahead, and there are three primary changes that can affect your wallet. The first, and most widely known, is the Cost of Living Adjustment, or COLA. This is the annual adjustment designed to ensure that the purchasing power of Social Security and supplemental security income benefits is not eroded by inflation. The COLA is calculated based on the Consumer Price Index for urban wage earners and clerical workers, or the CPIW, from the third quarter of the previous year. For most folks, the announcement of the COLA is the highlight of the fall because it means a bigger check starting in January. But this increase often comes with a subtle sting, which we'll cover in the next section, the Medicare deduction. The COLA announcement itself is a complex event. It's intended to provide relief, but it often falls short of the true inflation faced by seniors, which tends to be higher for things like healthcare and housing, categories that are sometimes underrepresented in the CPIW calculation. We see the average benefit increase by a set percentage, but the actual dollar amount is different for everyone. For someone receiving an average benefit, a certain percentage increase might add an extra $60 or $70 a month. This is money you earned, and it is a necessary adjustment, but it rarely feels like a windfall when the grocery bill and utility costs are increasing at the same time. The second major change on January 1st is the maximum amount of earnings subject to the Social Security payroll tax. This is known as the contribution and benefit base, or the taxable maximum. Every year, this number goes up to account for increases in the average wage index. This change primarily affects working professionals who are high-income earners. If you are currently working and your income is at or above the taxable maximum, you will find that you pay Social Security payroll taxes on more of your income starting in January. For example, if the maximum taxable earnings was, say, $160,000 one year, and it increases to $168,000 the next, then an individual earning $200,000 will be paying Social Security tax on an additional $8,000 of their income. This change, while not impacting the benefit you receive immediately, is a fundamental funding mechanism for the system, and it's a guaranteed January 1st adjustment. It's the cost of keeping the system solvent. The third change, which is vital for those who claimed benefits early and are still working, is the annual earnings limit. This is a very complex but critical rule that often catches people off guard. We'll spend a full section on this, but the limit itself resets and increases on January 1st. If you are under your full retirement age and you work while receiving benefits, your Social Security check will be temporarily reduced if your earned income exceeds this annual limit. These three elements, the COLA, the maximum taxable earnings, and the annual earnings limit, all reset and take effect on the first day of the new year. Understanding them is the key to preventing any unexpected surprises when that first check of the year hits your bank account. The system is designed to adjust, but sometimes those adjustments, especially when they are combined with increased deductions, can feel like a financial jolt. The biggest surprise that typically accompanies the January 1st COLA increase is the Medicare Part B premium deduction. This is why many people feel the Social Security increase doesn't feel like much at all. They see the COLA announced, they feel a moment of relief, and then they look at their January statement and realize a substantial chunk of that increase has been eaten up by a higher Medicare deduction. For the vast majority of beneficiaries, the Medicare Part B premium, which covers things like doctor visits, outpatient care, and preventive services, is automatically deducted from their monthly Social Security check. When the Part B premium increases, your net Social Security check goes down, even though your gross benefit may have gone up. The Part B premium changes every year, and it almost always increases. And this is not just a small increase. For example, the standard Part B premium might jump from one amount to a substantially higher amount. It's a necessary cost, but the timing is what makes it feel punitive. It happens the exact same month you are expecting the COLA increase to kick in. There is a protection in place called the Hold Harmless provision, which is designed to ensure that the increase in your Part B premium does not cause your Social Security benefit to decrease from one year to the next. For people who have their Part B premium deducted from their check, this provision guarantees that their net check will not be lower than it was the previous year. However, This protection doesn't guarantee that you'll feel any benefit from the COLA. If the COLA increase is, say, $60 a month, and the Part B premium increase is exactly $60 a month, your net check will stay exactly the same. The hold harmless provision is a safety net, but it is not a pathway to financial gain. Now, we also need to talk about IRMA, which is short for Income-Related Monthly Adjustment Amount. This is a crucial area where people can be caught off guard. IRMA is an extra amount you pay on top of your standard Part B and Part D prescription drug premiums if your modified adjusted gross income, MAGI, is above a certain threshold. The IRMA calculation is based on your tax return from 2 years prior. So, the IRMA for the upcoming year is based on the income you reported 2 years ago. This is a critical point that requires proactive attention. If you had a one-time surge in income 2 years ago, maybe you sold a house, a business, cashed out a large retirement fund, or realized a significant capital gain, that income could push you into a higher IRMA tier for the next year. And this jump can add hundreds of dollars a month to your total Medicare costs. The difference between the lowest IRMA tier and the highest IRMA tier can be thousands of dollars a year in additional premiums. The process is often confusing because there is a 2-year lag. You might feel like your current income is low, but the government is looking at a tax return from 2 years ago. If you experienced a life-changing event that reduced your income since that tax year, like retirement, divorce, death of a spouse, or loss of an income-producing asset, you have the right to appeal the IRMA determination using an SSA form. This appeal process can be essential in preventing a surprise deduction that is based on outdated income information. The key takeaway for this section is to budget for the inevitable increase in the Part B premium starting in January. And if you have income near the IRMA thresholds, be ready to review your previous tax returns and consider the appeal process if you believe your current financial situation warrants a lower premium. Clarity on these deductions is what keeps the January Social Security check from being a shock. Let's return to the third major January 1st adjustment, the annual earnings limit. This is a very specific, but very common, trap for beneficiaries who claim their Social Security benefit before their full retirement age and who continue to work. If you are under your full retirement age and you work, Social Security can withhold part or all of your benefits if your annual earned income exceeds a specific limit. And this limit increases every January 1st to reflect the average wage index. The rules here are precise and unforgiving. For every $2 you earn above the annual limit, Social Security will withhold $1 of your benefit. This can result in a significant temporary loss of benefits if you're not tracking your income throughout the year. For example, let's say the earnings limit for the new year is around $22,000, and you are projected to earn $32,000 this year. That means you are $10,000 over the limit. Social Security will withhold $5,000 of your benefits, $10,000 excess divided by 2. They don't withhold $5,000 at the end of the year. They withhold it proactively by delaying or reducing your monthly payments at the beginning of the year until the amount is recovered. The good news is that this reduction is not permanent. Once you reach your full retirement age, the SSA credits you back all the benefits that were withheld, essentially recalculating your benefit to account for that money. But in the short term, this can cause a severe cash flow issue, and the reduction can feel like a devastating loss. The rules are slightly different for the year you actually reach your full retirement age. In that specific year, the earnings limit is much higher, and the withholding ratio is more favorable. $1 is withheld for every $3 earned over the limit. Once you hit your FRA, the earnings limit completely disappears, and you can earn as much as you want without having your Social Security benefits reduced. The January 1st importance here is twofold. First, the limit itself officially changes. Second, your clock resets. This is the time to review your expected income for the entire year and proactively notify the Social Security Administration if you think you will exceed the new limit. It is far better to have Social Security withhold the right amount up front than to receive an overpayment notice later in the year, which is a stressful and confusing process where they demand the money back. The people most affected by this are often part-time workers, consultants, or those who took on a second career. The rules around what counts as earned income are also important to clarify. Earned income includes wages from a job or net earnings from self-employment. It does not include pensions, annuities, investment income, interest, or dividends. This is a classic scenario where a calm, early checkup can save you a world of headache and an unexpected temporary reduction in your income stream. The key is to know your income, know the limit, and communicate clearly with the SSA before January is over. We focused a lot on the specific numbers and the mechanics of the Social Security system, but I want to step back for a moment and talk about the bigger picture. We are all living in a time of persistent economic uncertainty. Inflation, high interest rates, and the general cost of living remain the backdrop to all of our financial decisions. And this is why having clarity on your Social Security check is more vital now than ever. The people I talk to every day, the folks who tune into this channel, are not economists playing games on a spreadsheet. They are real people managing rising credit card debt, looking at mortgage rates that have doubled since 2021, and watching their savings lose value due to inflation. They are people picking up part-time jobs in their 70s just to cover the cost of prescriptions or helping family members who are also struggling. The COLA increase, while helpful, rarely covers the true cost of living increase for seniors. When you combine the higher Medicare Part B premium with the rising cost of housing, utilities, and groceries, the average beneficiary still feels squeezed. That feeling of constantly running to catch up is what causes the frustration and the fear that fuels those dramatic headlines. This is also why understanding the January 1st changes is so important for long-term stability. The stability of your primary source of retirement income, your Social Security benefit, is the foundation upon which you build the rest of your financial life. If that foundation is constantly shifting due to unpredictable deductions or surprise overpayments, the whole structure can feel unstable. We must remember that Social Security is not a handout. It is the culmination of decades of hard work and payroll contributions. It is your money. And the reason we spend so much time here breaking down these complex rules, the FRA changes, the earnings limit, the IRMA, is because every single one of those rules is a potential tripwire that can reduce the amount of your money that actually makes it into your bank account. The goal is not just to receive a bigger check. The goal is to receive the correct check, calculated at the maximum amount you are entitled to, without any unexpected reductions. In an environment where every dollar matters, the difference between receiving your full benefit and receiving a slightly reduced benefit can be the difference between peace of mind and constant stress. And this leads to the important topic of assistance programs. The COLA increase, while small, can sometimes have an unintended consequence. It can push some lower-income seniors just over the income limit for other essential programs like SNAP, food stamps, or Medicaid. It's an unfortunate side effect of the way these systems are structured. If you rely on any assistance programs, the start of the year is the perfect time to check the new eligibility rules for that program based on the increased Social Security benefit. Don't assume you are safe. Check the numbers. Financial clarity in a confusing economy is not a luxury. It's a necessity. And taking these proactive steps is the single best defense against the uncertainty we all face. I want to circle back to the practical steps, the things you can do right now to ensure that January 1st is smooth, not stressful. Think of this as your calm, end-of-year financial checkup. Step 1. Check your full retirement age, FRA, and benefit calculation. Go online to your My Social Security account. Confirm your exact FRA based on your birth year. If you are close to retirement, run different claiming scenarios. See the permanent difference between claiming at 62, at your FRA, and at age 70. This is the absolute best way to neutralize the panic in that $4,000 loss headline. Seeing the numbers laid out simply allows you to make an informed, calm decision rather than an anxious, rushed one. Step 2. Scrutinize your earnings record. This is a step I stress every time because it is the foundation of your benefit. Your Social Security benefit is calculated using your highest 35 years of earnings. If even one year is missing or recorded incorrectly, a zero where there should be a number, or a number that looks suspiciously low, your benefit can be permanently lower for life. The government doesn't often catch these errors. You have to log into your account and scroll through the year-by-year history. If you see a mistake, correcting it now is much easier than correcting it 5 years from now when the tax records are harder to retrieve. This is a 5-minute task that can protect decades of income. Step 3. Review your tax withholding. Many people forget that Social Security benefits can be taxable, depending on your total income. If your combined income, adjusted gross income, plus non-taxable interest, plus half of your Social Security benefit, exceeds certain thresholds, $25,000 for an individual, $32,000 for a married couple, a portion of your benefit may be taxed. If you want to avoid a surprise tax bill in April, you can choose to have federal taxes withheld directly from your Social Security check using the simple Form W-4V. It is optional, but many folks find this gives them great peace of mind. Step 4. Update all contact and banking information. This may sound simple, but it is a leading cause of benefit delays. Make sure the SSA has your correct mailing address, phone number, and, most importantly, your current direct deposit information. If your bank merged, closed, or changed routing numbers this year, ensure the information is updated before January 1st. If a January payment gets sent to a closed account, it can take weeks of frustrating phone calls and paperwork to get the check reissued. An updated address is also vital because important notices, benefit reviews, and requests for information are often sent by mail, and missing one of these can lead to a suspension of benefits. Step 5. Proactively account for the Medicare deduction. Look at the projected Medicare Part B premium increase for the new year. Subtract that from your projected COLA increase. This will give you the actual anticipated net change in your January benefit. By doing this simple math up front, you eliminate the shock factor when the first check arrives. If you believe you may be subject to IRMA, gather your tax documentation now and prepare to appeal if necessary based on any significant life-changing events that reduced your income. This proactive checklist is the quiet work that separates those who feel constantly stressed by the headlines from those who are financially steady. It's about being the driver of your financial life, not the passenger. As we wrap up our conversation today, I want to leave you with a couple of final thoughts about perspective and the future of Social Security. We spent a long time today dissecting the fear around a dramatic headline. We replaced the panic with numbers and clarity. This is the core mission here at the channel. We believe that financial education should be calm, accessible, and centered on the human reality of money. The fact that money represents effort, sacrifice, and the ability to live with dignity. Social Security is a vital program, but it is also one that is under pressure long term. You hear the headlines about the trust fund facing challenges in the 2030s. I want to be crystal clear about what that actually means. It does not mean that the program disappears or that benefits stop. It means that if Congress does not act, the program would only be able to pay a reduced percentage of the promised benefits. That long-term reality is why the work we do now is so crucial. Making sure your earnings record is correct, choosing the optimal claiming age based on your FRA, and ensuring you receive every penny you are entitled to. These are the protective steps you can take today to safeguard your future benefit, regardless of what happens in Washington over the next decade. The system is complex, it's frustrating, and it's often confusing. But the complexity should not be a barrier to your understanding. It should be a challenge that we meet together with patience and a logical, step-by-step approach. The goal is always stability. The goal is always confidence. I know that managing money in today's economy can feel like walking through a minefield. There is always a new headline designed to startle you, always a new worry about interest rates or inflation. But your Social Security benefit is the one predictable anchor in this storm. Protect it, understand it, and claim it wisely. Thank you, truly, for spending this important time with me today. My hope is that we've taken the alarm out of that headline and replaced it with a clear, actionable path forward for the new year. If you found value in this deep dive, if the calm, detailed approach to this confusing topic helped you feel more in control, I invite you to subscribe to the channel. We are here every week, committed to explaining these complex financial shifts calmly, clearly, and honestly, with no shouting and no fear. What is the one thing about the January changes, be it COLA, Medicare, or the earnings limit, that still feels the most confusing to you? Drop that question in the comments below. We read every one, and your question helps us understand what we need to explain next, and it helps someone else who is feeling the exact same way. Check your FRA. Check your earnings record, and take care of yourselves. I will be back with you again soon.